Stocks get the headlines, but real estate quietly wins in ways most investors ignore. I want to walk you through 10 concrete advantages that make real estate a different animal than buying shares on an app. I'm Keith Hill, and I've built my portfolio by leaning into the predictable, controllable, tax-smart parts of property investing that rarely make the evening financial news. Here's 10 real estate advantages over stocks you probably haven't heard, in straightforward, actionable terms. This is a list, short, sharp, built for a 10-minute YouTube video. I'll explain practical examples, quick math, and the exact strategies investors use to amplify returns, cut taxes, and sleep better at night. If you want smarter investing content, like and subscribe now. Leverage, tax benefits, cash flow, control, forced appreciation, inflation protection, depreciation tricks, principal paydown, low correlation, multiple exit strategies. Stick around. Each point is designed to be actionable the moment you pause the video. Let's start with leverage, the quiet multiplier most stock buyers never truly access. Chapter 1. Leverage. Buy bigger with less cash. Real estate lets you control a large asset with a relatively small down payment and mortgage. That magnifies your percentage return on the cash you invest versus buying the same value in stocks. Example: put $50,000 down on a $250,000 rental, you control the whole property. 20% down gives you leverage most stocks simply don't offer. If the property rises 10% to $275,000, the asset gained $25,000. On your $50,000 cash, that's a 50% gain before cash flow and tax benefits. With stocks, a 10% move on $50,000 is just $5,000, a far smaller percentage return. Leverage also amplifies losses, which is why risk management matters. But properly used, it's a powerful tool. Leverage also works with cash flow. Rent can cover mortgage payments while equity grows. Mortgages are long-term liabilities, sometimes with fixed interest rates, which lets inflation and appreciation work for you. Buying with a mortgage lets you control growth while preserving capital for future deals. The key is conservative underwriting. Use realistic rents, vacancy, and cap rate assumptions. Use amortization schedules to model principal paydown and break-even months. If you can buy smart, leverage creates asymmetric upside that most stock investors never experience. Leverage opens doors to portfolio scale, own multiple properties, diversify by geography and property type, and compound returns using financing as your tool. Next, the tax advantages that change the math. Real estate has a host of tax benefits that change the math in a way stocks usually don't. Mortgage interest, property taxes, repairs, insurance, management fees. That reduces your taxable income in real time, so your on-paper cash flow can be far more tax efficient than dividends in a taxable account. Depreciation allows you to take a non-cash expense against income, further lowering tax liability, even while the property may appreciate. That disconnect, paper expense versus real appreciation, is luxurious and legal. For active investors, passive loss rules, real estate professional status can let you use losses to offset other income. For passive owners, cost segregation accelerates depreciation to reduce taxes early in the hold period, turning a marginally profitable property into a tax-friendly cash generator. Abatements, credits for rehabilitation, historic preservation credits, all improve after-tax outcomes. Tax strategies are complex, so work with a CPA who understands real estate. In short, real estate gives you tools to legally shift and defer tax liability in ways stocks rarely allow, improving after-tax returns and compounding power. Unlike dividend checks and capital gains that can be sporadic, rental properties produce monthly cash flow that you can count on. Positive monthly cash flow provides a predictable income stream that can cover expenses, build reserves, even pay your mortgage. That steady inflow changes investor psychology. It's easier to hold through downturns when the property pays you each month. Cash flow funds maintenance, capital expenditures, growth. You don't need to sell an asset to access its income. That's different from stocks, where realizing value often requires selling and triggering taxes. Rent can be reinvested into improvements that increase rent or value. Good underwriting focuses on true cash-on-cash returns, not just paper appreciation. That means modeling gross rents, vacancy, operating expenses, mortgage service to see the monthly bottom line. Positive cash flow cushions risk, a huge advantage when markets get choppy. Cash flow supports leverage. Lenders like coverage ratios and documented rental income. Strong cash flow helps you scale. Cash flow is income and information. It signals demand, pricing power, and market fit you can't get from quarterly stock reports. When you own property, you can directly influence returns. You set rents, choose tenants, schedule renovations, manage expenses. Contrast that with a stock. One small vote, zero control day to day. Whom you hire, what contractors you use, how aggressively you market, all materially affect net operating income. Optimize turnover, screen tenants, prevent bad debt. Active management is leverage. Improve curb appeal, upgrade kitchens, add amenities to justify rent increases and re-tenant for higher rents. Change lease structures. Convert unit mixes to match demand. Direct levers to change cash flow and value. Control requires bandwidth, partners, or a manager. But the upside for engaged investors is one of real estate's core advantages. Truly. Forced appreciation means you can make the property worth more through renovations, better management, or repositioning. It's not speculation, it's active value creation. Replace flooring, modernize kitchens, fix deferred maintenance, then raise rents. Add amenities or convert to income-producing layouts. Classic forced appreciation plays. Decreasing vacancy, reducing turnover, streamlining maintenance. All increase NOI, which, when capitalized, increases value. In stocks, you hope management executes. In real estate, you can be the manager of returns. Remodel the bathrooms yourself, right? Pair forced appreciation with financing. Add value. Refinance to pull equity. Redeploy to the next deal. The repeatability builds multi-property portfolios over time. Real estate is a proven hedge against inflation. Rents and replacement costs rise with prices, and when inflation heats up, rental income typically follows as market rents reset. Property values reflect higher nominal cash flows, preserving purchasing power better than static nominal returns. Fix the rate and inflation erodes the real value of your debt. You pay back yesterday's dollars with cheaper future dollars, while rents adjust upward. Rising replacement costs make existing properties more valuable. Supply dynamics support valuations in inflationary periods. Stocks can do well, but valuations are sensitive to rates and risk premia. Real estate's cash flow plus fixed-rate financing creates a more direct inflation hedge. Practical takeaway: own income-producing property with a fixed mortgage to get rising nominal income and a declining real debt burden, protecting long-run wealth. Depreciation is a non-cash expense that reduces taxable rental income while the property may appreciate, a unique accounting illusion. You report a deduction without spending cash, reducing tax drag annually. Cost segregation reclassifies components into shorter lives. Front-loading deductions. More deductions now mean time value benefits and more reinvestable capital. 1031 exchanges defer capital gains. Sell an investment property. Buy like-kind, preserve capital. Compound tax deferred. Stocks and taxable accounts face dividends and realized gains. Real estate offers tangible deferral and shielding when structured well. Work with advisors to structure cost segregation and exchanges properly. The rules are strict, but the payoff is real. Efficient tax planning is part of your return profile. Every mortgage payment includes principal paydown that automatically builds equity, a form of forced savings. On amortizing loans, the principal portion increases over time. Equity growth accelerates in later years. Combine mechanical paydown with market appreciation for two equity engines at once, without a taxable event. Stocks often require selling to realize gains and taxes. Mortgages build net worth passively. Use equity strategically. Refinance to fund down payments or renovations. Mortgages convert monthly payments into long-term ownership, while rent helps carry the load. Local real estate markets often move independently of stocks, reducing portfolio volatility. Supply. Local job markets, zoning, and demographics create cycles that don't always sync with national equity swings, buffering macro shocks. Illiquidity and local pricing lead to smoother short-term performance in many markets. Diversifying by city, property type, and tenant base further reduces correlation risk and smooths returns. Micro fundamentals aren't in index charts, yet they power property performance and long-term stability. Real estate offers a menu of ways to extract value. Sell, refinance cash out, do a 1031 exchange, implement BRR, or convert usage. Stocks generally force you to sell to access equity, often timing the market. Refinancing after appreciation or forced appreciation lets you pull tax-deferred equity and recycle capital into the next acquisition. 1031 exchanges defer tax while consolidating or upgrading your portfolio. BRR accelerates growth by reusing the same capital. Seller financing, partial sales, and joint ventures monetize value while keeping upside. Even on exit, recapture and gains can be managed with planning. You're not stuck with one path. Design exits to match tax impact, market timing, and personal cash needs. That adaptability is a major strategic advantage. Those are 10 advantages many investors ignore. We covered leverage, tax benefits, cash flow, control, forced appreciation, inflation protection, depreciation strategies, principal paydown, low correlation, multiple exits. Each one is a distinct lever to improve returns and reduce risk. Real estate isn't magic. It requires work, partners, and smart underwriting. But these structural benefits explain why so many investors allocate heavily to property. If you liked this breakdown and want practical next steps, watch our follow-up on getting started, deal sourcing and financing. Like, subscribe, comment which advantage surprised you. Watch the next video on how to get started with rental properties. I'm Keith Hill. Thanks for watching, and I'll see you in the next video.